Hey guys, welcome back to week 8 of the TFSA Portfolio Challenge, where I'm taking 3 years to turn $2,000 with a weekly deposit of $200 into $50,000. And every single week, I'll be showing you my portfolio, whether it's in the red or in the green. Throughout this video, the things I'm going to cover are Dogecoin, just because that's super hot right now, and I just want to address what's going on there, as well as talking a bit more about long-term investing and what my mindset is despite the market being quite choppy these days. After that, we'll go over my portfolio and end off the video with a couple of user comments and questions from last week's video. So if you guys got any questions about the TFSA portfolio, how things work, or how to invest in Canada, let me know in the comments down below, and I'll be sure to look at all the questions and comments and pick a couple to address in next week's video. For those of you guys who have been following me since the first part of this journey, around week 2 or 3, I made an announcement that if that video got 500 likes, I will be releasing a free portfolio spreadsheet tracker for you guys out there. And sure enough, that video hit 500 likes, so you can check the description down below if you want to make a copy of that spreadsheet tracker portfolio. So starting off with Dogecoin. So Dogecoin, my understanding of it is that it was a coin created more for fun, and right now it's become more of a meme coin. It doesn't really serve a purpose like other cryptocurrencies, and I think really the price has gone way past what it should intrinsically be valued at. If we look at Bitcoin, for example, Bitcoin has a bit of an intrinsic value based on the energy that it takes to mine it. Right now, I do believe that Bitcoin has actually separated from that baseline of how much it costs to mine a Bitcoin versus how much it sells for. But in the bear markets, we typically see that it ends up having a one-to-one relationship at certain points in time. But Dogecoin, on the other hand, doesn't really serve a purpose other than being a meme coin right now. I know there's probably other critics out there who are trying to find a purpose for Dogecoin and trying to prove that. But at the end of the day, the creation of Dogecoin and the creator itself behind Dogecoin have said it was really for fun, and they didn't believe that Dogecoin could have taken off like it has right now. So from that standpoint, Dogecoin to me is more like a gamble. I think right now buying into Dogecoin is really hoping that Elon Musk can push Dogecoin even further through tweets and other things that he does. But honestly, if it sounds too good to be true, it usually is. And in this case, I think Dogecoin, it sounds way too good to be true at a price of around 70 or 60 cents while filming this. And we can see that people who invested in Dogecoin just before Saturday Night Live happened, they got burned because Dogecoin was sitting around 87 cents, and once the show started and was on its way, Dogecoin dropped all the way to about 60 or even 50 cents per Dogecoin in Canadian dollars. And I think the main reason for this is people bought on rumor and they sold on news. So essentially leading up to the event, people are expecting Dogecoin to fly off when Elon Musk got on Saturday Night Live and talked about Dogecoin. And people are buying in droves, just expecting the price to go up for no real good reason other than Elon Musk talking about it. Now that's not something that actually brings intrinsic value to Dogecoin itself. At least I don't believe so. And the fact that we saw that Dogecoin sold off during Saturday Night Live really shows the mentality of all the traders who got in. Because they bought in, maybe a lot of people bought in around 20, 30, or even 5 cents per Dogecoin. And at the point that it hit 80 or 85 cents per Dogecoin Canadian, then those people who bought in very low have incentive to sell. And obviously there's a price target out there saying Dogecoin will hit $1 per Dogecoin. And when that price target is widely adopted by everyone, as the price gets closer and closer to $1, then people are more likely to take money off the table, because if the price target of $1 hits, then everyone knows that, oh, it's over, it's time to sell. So a lot of people were probably preemptively selling before it hit $1, because if the large majority believed it would hit $1 and they were planning to take profits there, just like every smart person would do, then you want to sell a little bit before them and take risk off the table. And that's probably the reason why we saw it sell off rapidly during Saturday Night Live. And ultimately another reason is, after Saturday Night Live, what else are people looking forward to for Dogecoin? But Saturday Night Live was basically the culmination of what everyone's hopes and dreams were of Dogecoin. And once that reached, people decided to run for the doors and sell out of all the Dogecoin. And that's kind of the story of Dogecoin that I see right now and how it played out and why people sold off the Dogecoin during Saturday Night Live. Honestly, I would not put any money in Dogecoin unless someone had a really good reason why Dogecoin is going to change the world and how we use money. I believe that placing bets on other cryptocurrencies like Bitcoin, Ethereum, XRP, XLM, these are other cryptocurrencies that have more use cases out there or are a store of value. And some of these coins have not yet taken off to the previous all-time highs. And typically we've seen in all the cryptocurrency bull markets that all the coins, all the altcoins, as well as Bitcoin go up in step. The next thing I want to address is why you should consider long-term investing while your portfolio is down 30 to 50% instead of selling out and going away and leaving the stock market. I think that there might have been a lot of people who have already left the stock market as retail traders because views on YouTube are pretty much down. And I think that there were a lot of people who bought in at the top and they saw their portfolios tank 20, 30, 40, 50%. And afterwards they saw that kind of loss, they couldn't bear it, they cashed out, packed in the bags and said, stock market investing is not for me. I think that's a sad reality of these bull runs. Whenever there's a huge rise up or some sort of crazy boom in stocks, there's a lot of people who like to rush into the market because they're looking to make a quick buck. Everyone has a short-term mentality, and I think that just kind of goes to show us our society's mentality as well. We want everything in an instant, like instant noodles, craft dinner, fast food. All these things give you that gratification instantly. However, if you want to ensure that you're going to win in the stock market, the only surefire way that I can see is long-term investing. Well, there maybe is a 5% chance that you will lose if you invest in the market like Japan, who's been pretty much in a recession for 40 years. However, if you dollar cost average, diversify, and invest in solid companies, I would say there's a 99% chance that you're going to be able to come out on top. Instead of those people who buy into these high growth hype stocks only and expect their portfolios to jump 20, 30, 40% every single year from here on out. So this series on my TFSA, I want to show you guys how I'm handling the stock market and my portfolio and just my mood as I go week to week. Yes, my portfolio is down right now by about 1.2% versus the TSX, which is up by, I think, close to 1%. So you could say that my portfolio is performing poorly. And maybe I should try to just scrap my strategy, restart from scratch, and figure out a better way to beat the market. However, that would be short-term thinking. I'm thinking about this more like 3 years down the road, where I believe that the companies that I'm buying have some sort of long-term macro trend for them, or maybe they're a short-term play in my portfolio for a good reason. I think that if you've mastered patience as well as you're willing to put in the time to do research, you're going to win more than you actually lose in the stock market. In the long run, what that means for your portfolio is that your portfolio will increase in value rather than leaving it up to chance like you do in a lottery ticket. So for those of you who are still in the market, investing for the long term, pat yourselves on the back because a lot of people probably aren't doing that. With that said, let's jump right into my portfolio and talk about what's been happening in the past week. So we're here in the portfolio metrics sheet, and we can see that in the past week, the TSX has risen 1.02%. However, my portfolio is actually down by 1.13%, and we'll go into the holdings to figure out why. So we go over to the total portfolio and just sort this by 1 week performance and see which are the worst performing stocks. So you can see in the past week, Kinaxis was down, Dollarama was down by 4%, and Enchos was down. Algonquin Power Corp was down, and Stella Jones was down as well. So there are a fair number of, medium and high risk stocks, if we look over here, that are down in this past week. I know that tech, or at least Canadian tech, isn't faring that well right now just because of the whole rotation out of high growth stocks. So it makes sense that Kinaxis and Enchos are down. If we change this to market value, we can see that Kinaxis and Enchos are two of the largest holdings in this portfolio. So that's mainly why my portfolio is down, is because my top two positions were down fairly large this past week. We can also see Air Canada is down pretty majorly. Overall, it's down about 8.5% since I started buying in. And that's just because there's a second lockdown or third lockdown in Ontario. Canada's not faring well with COVID right now. And people are worried with Air Canada, how they reported a 1.3 billion loss in the previous quarter, that if this company will survive. But I did mention in a previous video, the government is providing them some sort of line of credit and loans, as well as buying some stock. The government bought around $23 per share, which is honestly why the stock price went down, because the government sort of set the price at $23. Investors saw that and they decided to sell the stock off, because if the company was pricing their shares at $23 and the share prices were sitting at $26 the day before, there's some sort of disconnect in value that investors saw, or short-term investors saw, and sold off the stock. In the past week, I bought the Bitcoin ETF in 2 tranches, 5 shares and 3 shares for an average cost basis of $10.25 and $10. I also bought 2 shares of NShares at $50 per share, and I did receive a dividend from RioCan of 72 cents. As for next week, what I'll be looking to buy is more BTCC, building that position up to at least a book value of $200. I'll be looking to buy anytime it dips under $10.10, just because I do believe that Bitcoin has more room to run, and right now it's quite volatile, so I'm not too rushed to buy it when it's at like 1044 or 1050. I do believe that I can catch it on a downswing in the near future, and eventually Bitcoin will continue its run up in this bull market cycle. Another stock I'm looking to buy more of is Stella Jones. I believe that the housing market is fairly hot right now, and it's probably going to run hot for the next couple of years. At least that's my theory right now. And the reason why is I do believe that people require more space, and prior to the pandemic, a lot of people were rooming together, mainly millennials. People like us weren't able to afford properties or not willing to put out such a huge down payment. However, with the pandemic and workplaces shifting to a hybrid model or completely work from home, a lot of people require more space. Basically, they need a bedroom as well as a work office. And no longer does renting with roommates make it feasible in terms of the amount of space that people require. For this reason, I think we're going to continue to see an uptick in real estate prices in the near future. And Stella Jones is going to continue to benefit from that as people renovate houses to sell, as well as new houses being built. Another company that I want to buy this week is more Power Corp Canada. And the reason why is their net asset value last time I looked was about $40 per share. Currently, they're still sitting at $36.69, and that's still a difference of around $3.30. So there's still a value disconnect in Power Corp Canada, so I'll probably buy a couple shares this week. So now moving on to some questions. The first question comes from Brooke. Do you have a defined pension plan through your employer? And if so, how does that affect how much you contribute to an RSP? So currently I do not have a defined pension plan through my employer, but what I see very common is that employers will match your contribution to a RRSP or a pension plan. So how I believe it works is like you go with a bank like RBC, for example, and you have an account in there which your employer will contribute as much as you contribute into that plan. And through that, you can buy certain mutual funds. However, my company doesn't do that, but if it did offer that, I would take full advantage because the company is essentially doubling how much you put into it. Although mutual funds tend to have higher fees than ETFs, I think the fact that your employer is matching your contribution is already like a 100% gain. So I would personally try to max it out if I had that option. Now, the traditional sense of pension plans, at least how I understand them, is that an employer promises you a pension, and when you retire, they give you a set amount of money every single month. And it's not like you put it into an RRSP and they match it. So if my company did give me that, I still would utilize my RRSP. And the reason why I would do that is because it can help offset your taxes currently. And if you're making a fair amount of money, anywhere from like 60K onwards, you're paying a decent amount of tax. We're talking like 25 to 30% tax. So by contributing to an RRSP, and especially if you don't need the money right now, that's what I would personally do if I was in this situation, if my company offered me a pension plan that I didn't have to contribute into. I also wouldn't want to rely on a company's pension plan solely. I don't really know the stability of these pension plans. Sometimes I've heard that if a company goes under, you might not get a pension plan out of them just because the company is gone. So it's possible the company that you work for right now might not be around when you retire. So that's personally what I would do if I had a defined pension plan through my employer and how I would utilize the RRSP vehicle if I had that. If you guys have any questions or comments that you want me to address in next week's video, please leave them down below. I'll be putting up 2 videos on the screen here. If you guys want to check them out, I'll see you there. If not, keep up the grind and have a great day.